In the macroeconomics of the Great Depression, we want to see what policy measures were taken during the Great Depression and how they stack up with our macroeconomic schools of thought. First up, we're going to look at monetary policy. In 2002, Ben Bernanke, then a member of the Federal Reserve's Board of Governors, 4 years later he'd become the chairman, he publicly acknowledged what economists have long knew. Regarding the Great Depression, we did it. We're very sorry. We won't do it again. This was on November 8, 2002, in a speech given at a conference to honor Milton Friedman. Bernanke's academic focus had been the Great Depression. He's considered an expert, a specialist. He could be considered at the top of his field academically and then also in practice. And he claimed that the Federal Reserve's mistakes contributed greatly to the worst economic disaster in American history. Bernanke's statements are in line with the famous, comprehensive, and important work on monetary history by Anna Schwartz and Milton Friedman. They argued that the Fed's actions added an enormous weight on the economy and in fact made the Depression what it was. After the 1929 stock market crash, the Fed aggressively sold government bonds. The Fed increased the discount rate 4 times between 1928 and 1929. From 3.5 to 6%. These are major changes. What do these policies do? Increasing the discount rate, selling bonds and open market operations. They pull money out of the economy. What would you want to happen in a recession according to all of our monetary theories of macroeconomics? When you're in a recession, all of them say you want to put money into the economy. These policies, what are they doing? They're pulling it out of the economy. The money supply dropped by about 4% in 1930. That's a large drop. It dropped by 15% in 1931 and 9% in 1932. By the end of 1933, the money supply was 33% lower than it was in 1929. We were pulling money out of the economy. Why did this happen, and why did the Fed let this happen? First, we have to understand that the Fed did not have the same knowledge of macro theories that we now have. The competing schools of thought that we've covered have developed in the wake of the Great Depression. But we can still discuss some general reasons why the Fed took the actions that they did. In 1928 and 1929, the Fed was raising interest rates to slow down speculation. The Dow had really been on the rise, really rallying in the second half of the 1920s. It was the roaring 20s after all. You raise the interest rates to turn people away from the stock market and towards safer, less speculatory investments. A similar story can be told with the early 1930s reductions in the money supply. In 1931, Great Britain left the gold standard. Foreigners became concerned that the United States would do the same and began converting their dollar assets into gold. This caused an external drain on the gold reserves in the United States. And this external drain caused a large reduction in the US gold supply. At the same time, depositors became concerned about the safety of banks and thus withdrew currency from their accounts, creating an internal drain on the banking system. This alone reduced the money supply some. But the Fed's 1931 response to the gold drain was to increase the discount rate. The goal was to increase interest rates so that people would put cash back into the banks and avoid bank runs. Right? So bank runs are a major issue during this time period. The Fed repeated this policy in 1933. You can see pictured here a Detroit bank run from 1933 with people in line to receive just 30% of their deposits. Bank runs were a part of life in the early 1930s, and the Fed's response was to increase the interest rates to try and get people to keep money in the banks or to even bring some there. The early 1930s were not the only time the Fed's monetary policy impacted the Great Depression. Banks had grown very leery of bank runs by the middle of the Great Depression, and they began holding large amounts of excess reserves. The banks that had survived through this point said, we need to keep surviving. We need to make sure that we have excess reserves in case there ever is a bank run again. The people at the Fed worried that banks could start lending out some of these reserves and greatly expand the money supply and cause runaway inflation. There's now a risk of large inflation because banks held so much money in reserves that could potentially be lent out. The Fed was no longer in charge of the money supply, it felt. In 3 steps between August of 1936 and May of 1937, the Fed doubled the reserve requirements for banks. The thought is that this would not really impact the bank's holdings. They already had a whole bunch of reserves. So it wouldn't impact the holdings at all, as all of them are holding these reserves. But this way, the Fed would be in control of inflation if reserves started flowing out to investors, because only so much of that reserves could actually flow out. Banks were now required to keep a higher level of reserves. They had less excess reserves and more required reserves. So how did the banks respond to this? Well, they restored their level of excess reserves. We can see in this graph here that for quite a while, banks are holding right around 100% of their reserves held as reserve required. So we basically have no excess reserves. We get a bunch of bank runs, a lot of uncertainty, and what happens is we start really climbing here in the early 1930s and we get excess reserves. But then what happens is the Fed says, hey, we have too much excess reserves going on, and so we're going to really ratchet up the amount that you have to have. And so now we kind of reset everybody back to near 100%, where all the reserves that they have are just the required reserves. But the banks didn't just stop there. This is what the Fed wanted everything to be at, is to just stay right at this point right here, where they were in control of the reserves. But banks said, no, it's not that we just want to have reserves. We want to have excess reserves in case there is a bank run. We will be able to mitigate that problem ourselves. So what did the banks do? They tried to build back up their excess reserves, right? And so what they did is they kept bringing money in, but reducing the number of loans that they were extending out to build back up their excess reserves. This is reducing the money supply. The money supply is responding, as it should, to an increase in a reserve requirement. The monetary policy during the Depression would not be supported by any of our major macro schools of thought. Interest rates were rising. That's against the classical self-correction mechanism. Reducing the money supply is against the monetarists, the modern monetarists, and the Austrians wouldn't like it. And the new Keynesian and Keynesian monetary policy advocates would detest it. The monetary policies enacted are not just not favorable, but they are actively negative. The Great Depression's unfortunate monetary policy practices is a sad case where the policy meant well, but unfortunately caused great harm. Up next is going to be the perverse trade policy of the Great Depression, so click on the video here to go to the next video in this lecture series.